Welcome, everyone, to this deep dive. Today, we're looking into Iren Limited, a company really making some waves in the investment world lately.
Absolutely. Things move fast,
Yeah,
and you've got to stay on top of how companies are, shifting their game plan.
exactly. And our goal here is to, well, get under the hood a bit, see what's driving things at Iron, especially for anyone thinking about potential investments.
And iron's definitely worth looking at. That mix of Bitcoin mining and this big push into AI infrastructure, it's quite the combination.
It is. So we've got two main things steering this discussion today.
Mhm.
First, their March 2025 monthly update.
Right.
And second, this pretty major announcement about pausing Bitcoin mining expansion to really focus hard on AI cloud services.
A big strategic move.
Definitely. So let's kick off with that March update. Operationally, it looks like things were humming along quite nicely.
Oh, absolutely. The March numbers definitely showed some serious momentum. Data center capacity was up, operating at 660 megawatts.
660 megawatts.
Yeah.
That's a lot of infrastructure.
It really is. And it's key, right? Not
Yeah.
just for the Bitcoin side they already have, but for where they're heading with AI.
Then on the Bitcoin mining front itself, capacity was up too, wasn't it?
Yeah, it jumped up to 37 exahash per second. That was up from 31 EHs previously.
So for listeners, EHs, exahash per second. Think
Well,
of it like horsepower for mining Bitcoin. More means more mining power.
precisely. And they were looking like they were on a clear path to hit 50 EHs in the first half of 25. The immediate target seemed to be around 52 EHs for Bitcoin mining.
Okay. And how much were they actually sort of hashing it in March?
Their average operating hash rate was 30.3 EHs. Solid number.
Which naturally led to more Bitcoin being mined.
Yep. 533 Bitcoin in March. That was a nice bump up from February's 459 BTC.
So the core Bitcoin business, operationally strong and revenue-wise.
Revenue reflected that. $45.3 million for March. Shows the scale, like you said.
And the margins, that's always key for investors.
Definitely. For Bitcoin mining, the hardware profit margin was sitting at a very healthy 76%.
76%. That's pretty efficient. Shows a good gap between cost and value.
It does. Suggests they're running those operations well.
Okay, now let's switch gears a bit to the newer kid on the block, AI cloud services. Revenue there.
$1.6 million in March. Now, obviously smaller than the Bitcoin
Way
side.
smaller, yeah.
But look at the margin. Hardware profit margin for AI cloud was, get this, 97%.
97%. Okay, wow. That really signals something, doesn't it?
It screams potential. Even with lower revenue for now, that kind of margin highlights the immense value the market's putting on AI compute right now.
Huge pricing power, maybe, if they can keep that up.
Exactly. That could drive earnings growth much faster than Bitcoin mining, potentially. It really shows where the future profitability might explode for them.
And it's worth remembering, just a few months before, back in January 25, they were talking about even bigger Bitcoin goals, right? Like 57 EHs.
That's right. They had that bigger target, 57 EHs by the second half of the year, tied it to that big $1 billion ATM facility.
And they even threw out some illustrative EBITDA numbers like $826 million, assuming Bitcoin hit $100, and they reached that 57 EHs.
Yeah, which really shows how focused they were initially on just scaling up the mining side.
Yeah.
Makes the recent pause even more significant.
Right. So that brings us neatly to the big news, the strategic shift towards AI and HPC. Why pause the Bitcoin expansion now when things seem to be going well?
Well, it's a major signal.
Hmm.
They're essentially saying, okay, the Bitcoin engine is running well, but we see an even bigger opportunity over here in AI and high-performance computing.
So capping Bitcoin at 52 EHs frees up
But
capital focus.
both, I think, capital, yes, but also management attention, operational resources. They can plow those into building out the AI cloud services and the dedicated AI data centers.
And this links to their no HRDL strategy, doesn't it? Selling Bitcoin as they mine it.
Exactly. Instead of holding Bitcoin hoping it appreciates, they sell it. That gives them immediate cash to reinvest quickly into building more infrastructure. First mining, now AI. It's a bet on building, not just holding.
And the CEO, Daniel Roberts, he commented on this directly.
He did. Back in March, he basically said, look, as we finish this 50 EHs mining build-out, our focus is now shifting squarely onto scalable infrastructure for AI and HPC.
Pretty clear statement of intent from the top.
Very clear. Signals the future direction.
So what are the main drivers behind this pivot? Why make this big turn now?
Well, a few key things seem to be lining up. First, the Bitcoin mining they do have, is expected to keep generating really strong cash flow.
Like that $600 million annualized projection.
Exactly. So that provides a solid financial base. They can fund the AI build-out without completely tanking current earnings. It's like using one engine to build a potentially much faster one.
Okay, that makes sense. What else?
Second, just the sheer demand explosion for AI and cloud compute, it's undeniable. Iren already knows how to build and run big data centers.
Right, they have that core skill.
So they're perfectly positioned to jump on that wave. It's about adapting what they know for AI workloads.
And presumably that 97% margin we talked about is a pretty big carrot.
Oh, absolutely. That's the third factor. Why wouldn't you leverage your expertise in a market segment that offers potentially much higher margins? As the AI side scales, it could seriously boost overall profitability.
So taking proven skills, applying them to a potentially more lucrative market makes strategic sense.
Seems like it.
Okay, let's talk infrastructure then. Because you can't do AI or Bitcoin mining without massive power and data centers. West Texas, they have a lot of power contracted there.
A huge amount. This is really
That's
critical for investors to grasp. They've secured 2.75 gigawatts of power capacity in West Texas.
2.75 gigawatts. Just put that in perspective.
It's enormous. Enough to power a small city, easily. That's a massive competitive advantage in these energy-hungry industries.
And the Sweetwater Data Center Hub is the centerpiece of that Texas plan.
It is. That's planned for 2 gigawatts total capacity. It's coming online in phases. Sweetwater 1 is targeting 1.4 gigaW, aiming for energization around April 2026.
And Sweetwater too.
That's the other 600 megawatts, expected later, maybe late 2027. They actually locked down the grid connection agreement for that 600 milliW back in March, which was a big step.
Okay, massive scale. But why West Texas? What's the strategic draw?
Several things, really. First, access to renewables. It's a huge renewable energy zone that helps with power costs, obviously, but also appeals to customers wanting green compute.
Important these days.
Very. Second, connectivity. Lots of high-bandwidth fiber optic routes running through there. Essential for moving data fast.
And latency.
Low latency, around 6 milliseconds to Dallas. Crucial for many AI applications. And finally, they're using advanced liquid cooling, which is very water efficient. Important in Texas and good for sustainability creds.
So power, connectivity, low latency efficiency. Sounds like they picked their spot well. Those connection costs for Sweetwater 2, though, $4.1 million non-refundable, nearly $27 million refundable. Big checks to write.
They are substantial upfront costs, yeah, but necessary to secure the grid infrastructure for a project that size. Investors should see it as part of building a major long-term asset.
Okay. And besides Sweetwater, they're also expanding Childress, their existing facility.
That's right. Childress went from 600 milliW up to 750 milliW, and that extra 150 milliW is apparently immediately available.
How did they manage that?
Got the approvals needed from ERCOT, that's the Texas grid operator, and amended their agreement with AEP, the power company. Those approvals basically rubber stamp that the grid can handle it.
And Childress has good power costs, I hear.
Very good right now.
Yeah.
Around 2.8 cents per kilowatt hour. They shifted to spot pricing, and it seems to be paying off, especially for the Bitcoin mining still running there.
So optimizing the old while building the new. Interesting. But despite all this good operational news and strategic moves, the stock price took a hit in 2025. What's going on there?
Yeah, that's the disconnect that can frustrate investors. Solid performance, but the stock's down. It's likely broader market stuff playing a big role.
Yeah.
Weak U.S. manufacturing data worries. Talk about potential tariffs, tech stocks selling off generally, just overall economic jitters. These macro factors can create a risk-off mood that hits stocks like Iren, even if the company itself is doing okay.
So maybe not entirely company-specific issues, but analyst sentiment seems more positive.
That's the interesting counterpoint. JP Morgan actually upgraded them to overweight in March. Roth MKM had a buy reading, price target, way above the current price back in April.
And H.C. Wainwright saw the minor sell-off as a buying opportunity.
They did. And the average analyst price target suggested pretty significant potential upside. So you have this gap. Market pessimism versus analyst optimism based on fundamentals, something for investors to dig into.
Definitely food for thought. Suggests maybe the markets focus short-term, analysts longer term. What about that financial restatement? That word always makes people nervous.
Yeah, restatement sounds bad. But in Iren's case, announced in March, it seems mostly about presentation. They're changing how they classify Bitcoin sales proceeds on the cash flow statement.
Moving it from operating activities
To investing activities.
Yeah.
It's to align better with certain international accounting standards, IAS 7.16b specifically.
So not changing the bottom line. Profit loss, cash balance.
Nope. The company was clear. Profit loss, financial position, equity, cash equivalents. None of that changes for the periods affected. It's like moving cash from your wallet to your bank account. On paper, the total cash you have is the same.
And it's part of switching to U.S. accounting rules.
Exactly. Part of the move to U.S. GAAP as they become a U.S. domestic filer. So it's more accounting mechanics than finding some past error. Important distinction.
Good to clarify. Okay, let's get back to the exciting part, the AI build-out. That AI cloud services revenue growth looked pretty punchy.
It really did. 33% month-over-month growth in March, going from $0.8 million in January up to $1.6 million, if that keeps up.
It becomes significant pretty quickly.
Right. Could really move the needle on overall financials in the next few years.
And technologically, they're betting big on this direct-to-chip liquid cooling. Why is that so crucial for AI?
It's a potential game changer, especially with things like NVIDIA's new Blackwell GPUs coming on. Those things run hot and need serious cooling. Traditional air cooling struggles.
So liquid cooling is more efficient, like a car radiator versus a fan.
Exactly. It pulls heat away right at the chip, much more effective. It lets you pack chips much closer together, higher compute density. That's vital for powerful AI workloads.
And Iren getting ahead of the curve on this could attract customers needing that specific capability.
That seems to be the bet. Customers running the most demanding AI jobs will need this kind of advanced cooling. Iren's building it in from the start.
Smart. So they're not just building generic boxes, they're building for the high end of AI compute and the specific projects, Horizon 1 and Sweetwater.
Yeah, Horizon 1 is planned for an initial 50 megawatts of IT load. Potential to expand. CapEx estimated around $350 million.
And Sweetwater's the really big one for AI, too.
That's the monster. 2 gigawatts total power capacity. They're gearing it up for AI, ready to build fast once they land major customer contracts. Shows their long-term ambition in the AI infrastructure game.
Big ambitions need big funding. Where's the cash coming from for all this?
It's a mix. They're looking at customer prepayments, which is great, validates demand, and provides cash up front.
Reduces their own capital outlay.
Exactly. Also exploring debt financing, leveraging their assets, and they still have that ATM facility, that at-the-market program, as a backstop for equity if needed.
Seems like a sensible, diversified funding plan. Okay, let's talk differentiation. What makes Iren stand out from the crowd, both in Bitcoin and now AI?
Well, that no ODL Bitcoin strategy is one thing. Selling mined Bitcoin gives them constant cash flow to reinvest faster than maybe some competitors who hold onto their coins.
Fuels the growth engine directly.
Right. And the other big one is their in-house data center development team.
Having that expertise internally is a big plus.
Huge. Building these complex facilities, securing land and power, it's tough. Doing it efficiently in-house saves time, probably money, compared to relying on external developers or acquisitions. They control the process.
And apparently the market sees value in that. Reports of high valuations for their development assets.
Yeah, reports suggest their development portfolio is being valued at multiples of its cost. Indicates the market recognizes the value they're creating just by developing these sites.
Okay, so strategic Bitcoin sales, internal development muscle, key advantages. But we know there are headwinds. We touched on macro factors, but specifically for Iren.
Concerns about tariffs are real. Inflation isn't going away quickly. The Fed staying hawkish keeps borrowing costs up. It all creates that risk-off feeling that hits growth stocks.
And CEO Roberts acknowledged the tariff issue.
Said they're monitoring it closely. It impacts supply chains, costs. It's a real-world challenge they have to navigate.
And the stock's technical indicators weren't looking great back in April either.
No, they reflected that pressure. The RSI suggested it might be oversold, maybe too much pessimism baked in short term. MACD lines looked bearish, and it was trading way off its 52-week high.
So, challenging market backdrop for sure. Let's pivot back to the potential upside then. How could this AI focus really juice their overall performance?
This potential is definitely there. Those higher AI margins, 97% versus 76%, could significantly lift overall company profitability as that segment grows.
And it is growing fast, 33% month over month. Annualized run rate already $26 million.
Exactly. Analysts are projecting AI HPC could be, what, 45–50% of total revenue by 2026, driven by Sweetwater 1 coming online, those Blackwell GPUs. It's tapping into a massive growth market.
And it diversifies the business away from pure Bitcoin volatility.
Hugely important. Bitcoin mining is still the cash cow, projected at maybe $500 million plus annualized, but having AI grow rapidly reduces their dependence on just one market. Much healthier business mix long term.
What about the strategic infrastructure advantages from this AI focus?
Well, that massive 2.75 GW power position in Texas is key. potentially top 10 globally for data center power capacity. That's a huge moat.
And the tech leadership, the liquid cooling.
Crucial. Enables that higher compute density, makes them attractive for cutting-edge AI hardware, puts them ahead of operators still relying solely on air cooling.
And our customers biting. High utilization rates.
Reportedly, yes. High GPU utilization in March, driven by models like DeepSeek. And they mentioned a strong contract pipeline, advanced talks for big AI deals.
With those customer prepayments you mentioned.
Exactly. Those prepayments could cut their required capital spending by 30–40% potentially, de-risks the build-out significantly, and shows real customer demand.
And they seem pretty capital efficient overall, raising money smartly, low debt.
Yeah, the ATM raises were done at a decent average price. Debt to equity is conservative, and those internal estimates of a 3–5x markup on developed assets suggest they're creating value efficiently.
Financial metrics look strong too. Revenue growth, margins.
Impressive year-over-year revenue growth, strong gross margins around 90%.
Yeah.
And some analysts think their forward EBITDA multiple looks attractive compared to pure AI plays, maybe suggesting the AI potential isn't fully priced in yet.
So let's just crystallize that comparison. Bitcoin versus AI revenue in March.
Okay. March 2025, Bitcoin mining revenue, $45.3 million. AI cloud services revenue, $1.6 million.
Big difference currently.
On the surface, yes, but annualize it, Bitcoin, maybe $540 million run rate. AI, around $26 million run rate.
Still a big gap, but the growth is the story for AI.
That's the key. AI grew 33% in 1 month. Bitcoin is more established. AI is the rapid grower. And remember the margins. 97% for AI, 76% for Bitcoin. That's where the future profit boost could really come from.
Makes sense. Bitcoin a workhorse, AI the racehorse potentially.
Good analogy.
Now, one last challenge area. Tariffs and supply chains. How are they tackling that complex issue?
They seem to be taking it seriously, trying to diversify suppliers, not rely too heavily on one region potentially hit by tariffs.
And leveraging their internal team helps.
Definitely. Building more in-house potentially reduces reliance on imported components or external suppliers facing tariff issues, gives them more control.
What about managing the costs they can't avoid?
Focus on efficiency. That liquid cooling saves energy costs long-term. Getting cheap spot power at Childress helps. Every bit of cost saving offsets potential tariff impacts.
And strategically allocating capital, long-term power deals, funding with prepayments.
All part of it. Locking in power costs gives stability. Using customer cash and debt reduces reliance on buying potentially tariffed hardware with their own equity.
Plus, the CEO is actively monitoring and advocating.
Right. Suggests they're staying nimble and adapting and, focusing more on building domestic AI infrastructure might eventually align them with U.S. policy incentives, reducing long-term trade risks.
So, a proactive, multi-layered approach to a tricky problem.
Seems that way. They're definitely positioning for the long haul in what's clearly a changing world, both technologically and economically.
It really feels like the core story here is this strategic shift, leveraging the Bitcoin Cash machine to build a potentially much larger, higher margin business in AI infrastructure.
That sums it up well. It's a bold move, playing in two massive, converging tech sectors.
So key takeaways for listeners maybe considering Iren.
I'd say. Watch that West Texas power capacity. It's a huge asset. Keep an eye on their progress with liquid cooling technology. It's key for next-gen AI. Track the AI cloud revenue growth. Is it sustaining momentum? And monitor how they navigate those market challenges like tariffs.
It feels like, despite the market headwinds right now, the long-term strategy could position them really well at the intersection of crypto and AI.
It certainly could. It's a fascinating transformation to watch unfold, building infrastructure for potentially two defining technologies of the coming decades.
Absolutely. As always, though, we have to stress, do your own homework. This is complex, evolving stuff. Make sure any potential investment fits your strategy and risk tolerance.
Couldn't agree more. Thanks for tuning into this deep dive on Iren Limited, everyone.
Yeah, thanks for listening. And please, if you found this useful, do subscribe to the deep dive. Maybe give us a like and hit that notification bell so you catch our next exploration into the companies and trends shaping the markets.